Welcome Accounting Boffins, you with Ashraf Patel. What are we looking at today? Today's focus is on adjustments, revising the income statement, also known as the statement of comprehensive income. Okay, now what is it that you need to know? Firstly, when you're dealing with your financial statements, the one that we're dealing with today is the income statement. Keep in mind that you're working from a pre-adjustment trial balance, right? Obviously, you're going to do some calculations and you're going to do the necessary adjustments. And based on that, you're then going to update information into your income statement, right? Also take into account the financial year end we are working with, and obviously the final accounts which will appear in the general ledger. Right, so before we actually continue with the adjustments, a quick reminder. When you're starting off a question, the first thing that you look for is to check whether any of the big five, we're not talking about the tiger, the lion and all of that. What we're talking about are accrued income, income received in advance, accrued expenses, prepaid expenses, consumable stores on hand. Check whether or not they appear in your pre-adjustment trial balance. If they do not appear, it means that your reversals have been done. But don't take for granted that it will always be the case, because if you pick up any of the big five in the pre-adjustment trial balance at the end of the year, it means that the reversals have not been done and must therefore be taken into consideration. All right. Okay, let's go right into the question and see what is it that we have to work out. It says there, find the missing values for sales shown in that we need to use for our comprehensive income, calculate the gross profit. Okay, here goes. Initially, you find that your sales figure is an unknown, right? Okay, but in terms of the information, what do we know? Goods are sold at a markup of 60% on cost, right? And then you are told a credit note for the return of merchandise sold, 12,480, was omitted from the debtors allowances journal on the 15th of February 2020. The goods were taken into stock, but no entries were made. Right, how are we going to deal with this? Step number one, you take your initial cost of sales, which is 7,540. Obviously, from where, here we go, we can see our cost of sales is 7,540,000. That's my given figure. What do I do with it? I start off by saying, take your 7,540,000. Let's do this calculation together. 7,541,230 times 160 divided by 100. Why am I doing that? Because I know that we have a markup of 60% on cost. And this will give me a figure of 1,206,000. It'll give me a figure of 12,064,000. There we go. So there's the initial calculation. Right, 12,064,000. So what have we done? We've taken the cost of sales figure of 7,540,000 and we've marked it up by the markup of 60% on the cost price. So you're starting off from a cost of sales figure working towards a sales figure. Clearly you can see that when you mark up the goods on cost, to add the markup to the cost price will then increase it to give you your selling price. Right, but I also know that a credit note for the return of merchandise sold was 12,480. Okay, now we know that that is your debtors allowances, and therefore what happens to debtors allowances? Debtors allowances is subtracted from your sales figure, and therefore that part there would be your debtors allowances figure of 12,480 to give you your final sales figure of 12,051,520. So, what have we done? We started with the cost of sales, added the markup, came to our sales figure, then we subtracted our debtors' allowances. Now, a point to consider. Debtors' allowances will always be subtracted from my sales figure, right? Now, this adjustment will not be told to you. In this particular example, it appears as an adjustment, but if you find that you have debtors' allowances as one of the items in your pre-adjustment trial balance, remember, take that figure and subtract it from your sales figure. Why? You're transferring your debtors' allowances from your sales. In other words, sales less debtors' allowances. Okay, so we've sorted out our sales figure. Let's continue. So there's my sales figure sorted out, which is 12,051,520. Okay, coming to cost of sales. We've worked out the cost of sales, the markup to be 60%. Here's your return of merchandise. The selling price was 12,480. So obviously, if you want to work out the cost of sales there, you say 12,480, right? You want to calculate the cost of sales. The selling price of that particular credit note was 12,480. You want the cost price in order to adjust the cost of sales amount, okay? And how are we going to do that? Times 100 divided by 160, and this is going to give you a figure of 7,800. So what is the 7,800? You've calculated the cost of sales to be 7,800. The cost of sales of that particular credit note of 12,480, the cost price of those goods amounted to 7,800. I repeat, the 12,480 was the selling price of the goods that were returned, and the cost price was 7,800. Therefore, if you look at your cost of sales now, there's the initial figure of 7,540,000 minus the 7,800. Why is that? What's my double entry? When goods are returned, it's a debit. Let's do the selling price first. It's a debit to debtors' allowances, a credit to debtors' control with the selling price. The second part of my entry, a debit to trading stock and a credit to cost of sales. Therefore, watch this here. There's my trading stock, a debit to my trading stock. Why? The goods are coming back into stock, and a credit to my cost of sales. Here you can see you're crediting your cost of sales. Let's just erase that and pick up our pen again. Here's my cost of sales, and I am crediting, I'm debiting trading stock, crediting cost of sales, 7,800. Clearly, a credit to cost of sales indicates a subtraction in your calculation. So therefore, 7,540,000 minus the 7,800 will give you a figure of 7,532,200. Therefore, here you can see, going back to my gross profit part of my calculation, sales, I started off with my cost of sales, I added my markup, I subtracted the return. Can you see how important it is to show your calculations? Remember, that component, the 7,540,000 times the markup gave you the 12,064,000. You then subtracted the return of merchandise of 12,480 to give you your final sales figure of 12,051,520. Coming to your cost of sales, you started off with a given figure of 7,540,000. Okay? So there's my 7,540,000 minus my return. Remember, that was the selling price of the return, and that was the cost price of the return. So that gave me 7,532,200. I now say sales less cost of sales and therefore I have my gross profit, which is 4,519,320. Okay, so in all of those calculations, what is it that you must take note of? One, determine your sales from your cost of sales. It could also be to determine your cost of sales from your sales. So just depending on the question. In this one here, you were given the cost of sales and a markup, you had to work out your sales figure, right? Take into consideration, once you have your sales figure, look for your debtors allowances. Subtract your debtors allowances from your sales. Next, go to your cost of sales. The moment there's a return of merchandise, there's always two parts to the entry. The first one is a debit to debtors allowances, a credit to debtors control with the selling price, and the cost price. The double entry is a debit to trading stock and a credit to cost of sales. Therefore, a credit to cost of sales means a subtraction here of 7,800, and this then gives you your gross profit of 4,519,320. Okay, done and dusted. Let's go on to the further adjustments that we are given. And the first one says, okay, here's my pre-adjustment trial balance. Let's put into practice what we preach. What are we checking for? Let's go through this list to identify, does any of the big five appear? Let's check. There's my capital, loan, vehicles, equipment, accumulated, trading stock, provisions, sales, cost of sales, rent income, salaries and wages, insurance, commission income, bad debts, interest expense, interest income, sundry expenses. Right. So none of the big five are appearing, meaning that all the reversals have been done. Hunky-dory, we don't have to be concerned about those. Okay, now they're telling you stock costing 37,500 Rand was stolen, right? The insurance company has agreed to pay out an amount of 26,250, which is still receivable, right? Important. Okay, so immediately I know now, what do? I go to my loss on theft of stock. 37,500 was the initial amount minus the 26,250. Let's do that. And we see that we have 37,500 minus 26,250, the amount that's receivable from the insurance company. 11,250 is the amount of stock that we are losing, right? Okay, now, although this doesn't fit into the income statement, the amount that you have to receive from the insurance company is your insurance claim. Now, take into consideration that your insurance claim, right, this figure will appear in my statement of financial position, namely my balance sheet, under trade and other receivables. Very important. One of the items that's going to appear there will be the insurance claim of how much? 26,250, because that's the amount that the insurance company owes us. Right. So in terms of my income statement, what do I have? I have a loss of 11,250 due to the theft, and therefore it will appear in my statement of comprehensive income. Right. An EFT for 10,150 was received from the trustee of a debtor who was declared insolvent. This represented a dividend of 40 cents in the rand. The balance must be written off as a bad debt. Okay, watch my calculation. I need to find out what portion is my bad debt. So I say the amount that I received was 10,150, and this is equal to the 40 cents, meaning I was told that this represented a dividend of 40 cents in the rand. Therefore, I now say fine. The 60 cents in the rand is my bad debt, which is equal to my unknown. How do I solve? Cross multiply 10,150 times 0,6 divided by 0,4. Let's do that. So we got the 10,150, right, times 0,6 divided by 0,4, and that will give me the bad debt amount of 15,225. What do I do with that bad debt amount? Watch what I do with it. Here we go. I find my bad debts. I identify it with 2779. Immediately I say, fine, there's my bad debts. First, my pre-adjustment trial figure of 2,779 plus the 15,225, which was my bad debt from that particular adjustment. Add the two figures together. Let's do that. So we've got the 15,225 on our calculators already. Add the 2,779, and that will give you a figure of 18,004 Rand. What is the 18,004 Rand? That is your bad debts figure for the year. So, step number 1, identify the bad debt figure from your trial balance, number 1. Have I done that? Yes, I have. What was the amount? 2,779. Step number 2, was there a further bad debt? Yes. As a result of the insolvent estate, I lost out a further amount of how much? 15,225. Therefore, add the two together to give me my final bad debts figure to appear in my statement of comprehensive income as 18,004 Rand. Okay, so guys, you can see follow procedure when it comes to your adjustment. Find the amount in your pre-adjustment trial balance, do the adjustment, and then get your final figure. Just before we conclude this segment, let me just show you how this will be marked in the exams. Okay, so if you are marking this in the exams, this is what happens. 1 mark for that figure there, which is your trial balance figure. 2 marks for the calculation, and a method mark for the answer, right? So you can, we're going to assume that you're going to get everything right. So you're going to get, for this particular one, you're going to get full 4 marks. However, if you make an error with the calculation, you can still get the part marks, these 2 here. Can you see? So you can still get maybe 2 out of 4. So what's important, guys, is to show your calculations, right? Let's take a quick break. Let's refresh. When you come back, we continue with further adjustments. See you just now. Welcome back, guys. We're busy with adjustments. Remember, we said important. Whenever you're dealing with adjustments, remember, accrued income plus deferred income minus accrued expenses plus prepaid expenses minus. What am I referring to? I'm referring to the operation that you're going to show in the bracket. And then obviously consumable stores on hand minus, or depending on the information that's given to you. Right, let's look at this adjustment now. Stock taking on the 28th of February reflected trading stock to be 1,234,800. Step number 1, go and find out, did you have any further adjustments on stock? Yes, we had. There was a stock returned of 7,800. We've already done that calculation. And there was stock stolen to the value of 37,500. We've done that calculation as well. Okay, this means therefore, if you look at your trading stock figure, let's identify it from my balance sheet. Here we go, 1,287,000. Okay, so I take my 1,287,000 as my starting point, add the stock that was returned by the consumer, less the stock that was stolen, the 37,500, less what was my stock figure as per my stock take. Here we go. As per my stock take, my final stock figure was 1,234,800. There we go. And therefore, you find that that is your final stock figure as per your physical inventory. Meaning, if you look at it, if you do the calculation, you find that there's a shortage of 22,500. In other words, if you want to, let me just show you the trading stock account as a T account. Opening balance, 1,287,000 is your opening balance. Add the 7,800 less the 37,500 that was stolen, and your closing balance has to be 1,234,800. Okay, so if that's the information that you have, you find that the missing figure will be what? Watch this here. Let's do the calculation so we can see it. 1,287,000, right? Plus 7,800 minus 37,500 minus 1,234,800, and there you go. 22,500 clearly is your missing figure, meaning you have an entry for what? Trading stock deficit. A debit of 22,500 and a credit to your trading stock of 22,500. Now watch this, guys, important. There's my calculation. I've also showed it to you in the form of a T account. The same thing, 1,287 plus 78 minus 37.5 minus the closing balance will give you your trading stock that you've identified, the trading stock deficit to be 22,500. All right, so summarize that. Opening balance of your trading stock, look at any other adjustments that you have on stock, then compare it to your final balance to either give you a trading stock deficit or a trading stock surplus. Okay, let's move on to the next adjustment. It says here, provision for bad debts was 10,200, that was your opening balance, right? Provision for bad debts must be decreased to 9,700. Once again, watch this here. Simplest way of doing it, your current provision is 10,200, right? We know that provision for bad debts is a negative asset with a credit balance. What must your new provision be? Your new provision must be 9,700. Clearly you can see that if your new provision is 9,700, meaning that if you take that figure, let's do that, 10,200 minus the 9,700, clearly you can see that in order for this to happen, you need to debit your provision for bad debts with 500 Rand, and you're going to credit an account called provision for bad debts adjustment. So when we are decreasing the provision for bad debts, watch here. There we go. Provision for bad debts is 10,200, must now become 9,700. We are decreasing it, meaning that your provision for bad debts adjustment, when you are decreasing your provision, it becomes an income. When you are increasing your provision for bad debts, it becomes an expense. Which account? The adjustment account. Okay, remember, provision for bad debts is a negative asset. Why? It reduces the balance of your debtors. So it's debtors less provision for bad debts will give you net trade debtors. In our particular example, we are decreasing the provision, therefore the 500 Rand becomes an income amount under our other income provision for bad debts adjustment. How much? 500 Rand. Okay, next one. Okay, the next adjustment that we have, we are told the rent for February 2019, here we go. The rent for February 2019 was still outstanding, right? So immediately we know that we are dealing with an outstanding amount. What do we look at? We look at the fact that it's a rent. Let's identify the account. It's your rent income, right? And this means that you are looking at accrued income because the rent is still outstanding. Immediately you know, because it's an accrued income, let's make a note of this, because it's an accrued income, immediately what's going to happen is in my bracket, I'm going to have a plus sign, and that is linked to the accrued income. Okay, so that's step number one. Now we're going to do the actual calculation. So we identify rent income as 158,200. Let's do that. So we say, fine, let's take the old rental to be 100% because we don't know. All that we know is that rent was increased by 10% on the 1st of November. Okay, meaning therefore, let the old rental be 100 for how many months? 8 months. Why 8 months? From the beginning of your financial year, which started in March. So here we go. It's March, April, May, June, July, August, September, right? And the rent was increased. Let's just get the date right. The rent was increased on the 1st of November. So September and October. If you count this, it gives you 1, 2, 3, 4, 5, 6, 7, 8. So these 8 months represents the old rental to be 100. So multiply 100 by 8 to give you 800. Then your rental was increased by 10%. Therefore, watch this here. 100 plus the 10% will give you the 110 we want for our new rental. And it was only received for 3 months. How do we know that? Because we are told in our adjustment that the rental was still outstanding for February. That means you have received rental for how many months? The new rental was November, December, and January. Therefore, 110. So that will be your November, December, and January. Can you see the 3 months? There we go. There's the 3 months. Multiply that by 110 times 3 will give you 330. Now watch. Add that component. The 800 plus the 330 will give you 1,130, which is equal to the rent amount which we've established to be 158,200. There we go. There's the 158,200. So in terms of percentages, the 1130 is equal to the rand value of 158,200. What are we looking for? We're looking for the 1 month, which is the February month, which is outstanding here, right? And the February, you can clearly see, is 110 month. Therefore, 110 is equal to my unknown. Cross multiply 158,200. Let's do this calculation together. Here we go. 158,200, which was my rental figure, times 110 divided by 1130, and there we go. We have our figure of 15,400. What is the 15,400? That is your accrued income for rental. Now, in terms of my layout, watch, this is what I do. I start off with the 158,200, once again, identifying it from my pre-adjustment trial balance, 158,200. And remember what we said, there's that operation, important, very important, that is as a result of accrued income. So plus the 15,400, which was my calculation, which we just went through to give me a final figure of 173,600. Okay, let's summarize this rent entry. Step number 1, make your old rental be equal to 100. Then you either increase it if there was an increase, or you decrease it if there was a decrease. In this particular example, there was an increase of 10%. Determine, ascertain how many months were subjected to the old percentage, namely the 100. In our case, it was 8 months, therefore 100 times 8 to give me the 800. Then your new months, 110 for 3 months, add the 2 percentages, equate that to the rand value, and find your missing figure. Most important, it was an accrued income, therefore my operation is a plus. In my bracket, as you can see, there we go. There's my bracket, 158,200 from the trial balance. So that's your trial balance figure. There's your adjustment. And what was my adjustment? An accrued income. A debit to accrued income, a credit to rent income. Once again, let me illustrate to you why a plus. Here's my rent income, right? It's an income account with a credit balance of 158,200. That's the figure. Double entry, debit accrued income. Here we go. There's my accrued income. Debit it with 15,400 because it's a temporary asset. A credit to rent income of 15,400. Here you can see the fact that it's on the same side means you got to add. That clearly indicates to you that your new figure is 173,600, and that's the figure that will appear in my statement of comprehensive income. Okay, let's look at the next adjustment. It says here, calculate the interest expense. Right, how are we going to do? We're going to start off with our balance at the beginning of the year, which is 2,620,000. Repayments during the year, including interest, was 510,000. The interest capitalized is my unknown, and my closing balance is 2,398,200. The easiest way of doing this, guys, is to have your loan account. Step number one, loan account, opening balance. Notice you don't need any details, just the figure, 2,620,000. Step number two, repayments. That actually is your bank figure. Again, this is just extra, but the fact that it's on the credit side indicates that you've paid and therefore you bring in your payments. Step number three is your closing balance. Bring in your closing balance of 2,398,200. All that you now do is you take your figures of 2,398,200 plus 510,000 is equal to that, minus your opening balance 2,620,123, and voila, there we go. What do we have? 288,200 as the interest that is capitalized. Watch. Here's my calculation once again. 2,398,200. There. I'm showing you exactly what we're doing. Add the 510,000 minus the 2,620,000, and there we go. There's my closing balance for my loan, for the interest on my loan rather, to be an amount of 288,200. Okay, so when you're dealing with the loan, step number one, opening balance. Step number two, your bank, your repayments, the total amount. Step number three, bring in your closing balance. Once you've done all of that, your missing figure will be your interest expense, right? What's the double entry for the interest expense? A debit to interest expense and a credit to your loan account. Let's look at it. Here we go. There we can see it. A debit to interest expense, a credit to my loan account, 288,200. So in other words, your interest expense for the year amounts to 288,200. Recap on the loan, opening balance, closing balance, bank repayments to find your missing figure, namely your interest expense. The fact that interest is capitalized means you debiting interest expense and you crediting the loan account. When we say capitalizing the interest, it means that the interest goes back into the loan account. Let's take a quick breather, guys. When you come back, we continue with the adjustments. Welcome back, accounting boffins. Yes, we involved with adjustments and we're getting to grips with the adjustments. Let's look at the next one. What is required of us here? We are told included in the vehicles count is an amount of 950,000 Rand for a delivery van which was purchased on the 1st of December 2019. Vehicles are depreciated at 20% per annum on cost. Right. In terms of my calculation, step number one, find your vehicles figure. As you can see, let's pick it up from here. Vehicles, 1,520,000. Okay, so there's my vehicles figure, 1,520,000. Step number one, start with the opening balance minus the new vehicle. The reason we're subtracting it, included in the vehicles account is the 950 for the new vehicle. Therefore, minus your 950 will give you a figure of 570,000. So obviously your old vehicles are valued at 570,000. How are we depreciating? We are depreciating on cost. So I know it's just the one figure that I need, namely the 570,000 times the 20%. Let's do that calculation. So we get our depreciation figure, 570,000, which is my old vehicles, times the 20%, because it's 20%, that's your amount. The 570,000 is your amount. Your rate is 20%, times 12 divided by 12, that's a time, and that will give you a figure of 114,000 Rand. Okay, so that's my depreciation on my old vehicle. Let's do the new vehicle. We purchased the new one for 950,000, so immediately we say fine. Let's take the new vehicle now, 950, 1, 2, 3, times 20%, which is my rate of depreciation, times 3 divided by 12. And that gave me a figure of 47,500. Why times 3 divided by 12? This vehicle was purchased when? On the 1st of December. So it was used for December, January, and February. That's where we're getting the 3 months from. So in my calculation, times 3 divided by 12 gave me 47,500. So there's my total depreciation on my vehicles. Okay, so if we take those two figures now, and obviously let's edit, it's the 47,500 plus the 114,000, that will give me 161,500. What is the 161,500? That is the total depreciation on my vehicles. Right, what is it that we have to remember? When you're doing a calculation on depreciation, separate the old from the new. The next question that you ask yourself, is the new vehicle part of my opening balance or not? If it's included, separate it. If it's, or deduct it rather. If it's not included, keep it as two separate calculations. But in any case, keep the calculation separate into old and new. However, the old, the challenge there is the new vehicle part of it or not? If it's not part of it, straightforward. If it is, first remove it, then do your calculation. Okay, next one. On the 31st of August 2019, a computer was taken over by Paul Kluwer, one of the directors for personal use, for 8,000 Rand cash. The relevant page from the fixed assets register is provided below. No entries have been made in respect of the disposal of this asset. Equipment is depreciated at 20% per annum on the diminishing balance method. Immediately I know carrying value, why diminishing balance method? Right, let's look at the calculation. So here's the fixed asset register. Clearly I can see the cost price of the asset was 30,000 Rand, right? What was its accumulated depreciation? The accumulated depreciation before the current year was 13,680, okay? So now, what am I going to do? Step number one, go and identify your equipment account, which has a balance of 660,000. There we go. So let's do this. The equipment in red, 660,000 is my opening balance. So therefore, I start off by saying 660,000, there's my equipment. Again, just to verify, there's the figure. What was the accumulated depreciation? 484,500. So what are we doing here now? We're saying that, let's just get this figure correct here. Accumulated depreciation on vehicles. The 484 was the vehicles figure. That's not the one that we want. We want the 178,000. Therefore, let's just make this change here. This is incorrect. That's supposed to be 178,000. Clearly you can see there's the 178,000 in my bracket. So because it's diminishing balance, I need two brackets. Step number one, first 660 from my given information. Step number two, the accumulated actually this should say not that is why it's the vehicles amount, that should be equipment. So we've corrected that now. There's my equipment accumulated depreciation on equipment is 178,000. There's my 178,000. Right. Now, the asset that I'm disposing of, the equipment, had a cost price of 30,000. Here we go. There's the 30,000. So, in my calculation, minus the 30,000. The accumulated on this computer was how much? There we go. 13,680. Therefore, minus 13,680. So, let's take our figures. So, step number 1, we go 660,000 minus the 30,000, and that will give you a figure of 630,000. Okay, so that figure there, the net effect of that is 630,000 minus, if you look at the other one now, your 178,000 was the opening balance, 178,000 minus 13,680, and the figure there is 164,320. 164,320. So what do we do now? Now we take our 630,000 minus the 164,320 to give you a figure of 456,680, and then our rate of depreciation we knew, did they tell us, was 20%. Okay, so here we go. Let's do that there in our calculation, times the 20%, and this will give you a figure of 93,136. There we have it, our accumulated or the entry for the depreciation on the old equipment. Okay, now, what is important here? You had to separate the asset that you disposed of, you had to remove it from your calculation. Why were we using two brackets? Because it was the diminishing balance method. So you've got cost price minus accumulated depreciation. Important, remove the cost price, remove the accumulated depreciation. But remember, when you're removing the accumulated depreciation, it's your balance at the beginning of the financial year, not the total accumulated on that asset that you are disposing of, but rather the balance at the beginning of the year. Okay, the next thing that we do now is we look at the asset disposal. Once again, there's my cost price of 30,000. There's my accumulated depreciation opening balance, right? If you work out your current depreciation, what do? Let's do the calculation together so you can see what we're saying. It's your cost price of 30,000. There we go. The cost price of 30,000, right? Minus your, we need the other slide. Let's go back. That's the one, right? So here we go. Minus your accumulated of 13,000. Let's start all over again. Delete. 30,000 minus 13,680, which was my accumulated depreciation, gave me that figure, right? Times 6 divided by 12, and that gave me a figure of, let's redo the calculation. So we got 30,000 minus 13,680, gave me that figure there, times the 20%, okay, gave you that, times 6 divided by 12. And that gave me a figure of 1632. What was the 1632? That was my current year's depreciation. Add it to my accumulated to give me a total accumulated of 15,312, right? Now you subtract 30,000. Let's take the 30,000, which was my cost price, minus my accumulated of 15,312 to give me a figure of 14,688. There's my carrying value. I sold it for 8,000 Rand. Clearly you can see that your selling price is less than your carrying value, indicating you've made a loss. A loss of how much? 6,688 in this case here. Right. Now what do? In terms of my depreciation, I take the 114,000 Rand, which I calculated already, plus the 47.5, plus the 1632, plus the 93,136 to give me total depreciation of 256,268. Let's identify those amounts. There we go. 114,000 was the vehicle's old. The vehicle's new was 47.5. Let's see if we have them there. 114 plus the 47.5. Remember, on your sold equipment, namely the computer, was 1632, and then we also worked out the other one, the equipment on the old equipment, the 93,136, and that gave me the 93,136. My total depreciation was 256,268. So, for my statement of comprehensive income, I need my total depreciation. In this case here, it was the old vehicle plus the new vehicle, the sold equipment, namely the computer, plus the unsold equipment, total depreciation figure. And now, the next thing that we do is we look at our format of our income statement. What do we have? We have our commission income, we've adjusted our rent income, we had our provision for bad debt adjustment as an income that gave you gross operating profit. Okay, then you took the operating expenses, salaries and wages, insurance, bad debts. Now all of these, we did the adjustments. There's the calculation. There's your loss on theft. There's your adjustment. Remember the loss on sale of asset as well. We've done the adjustment. Here's your trading stock deficit. We've done the adjustment as well. And obviously the depreciation, we've shown you the calculation. Because you've done the calculation prior to it, if this would actually feature in your statement of comprehensive income as your calculations shows here, depreciation 256,268. You've got your operating profit. You've add your interest income. You bring it, that will be your operating profit before interest expense. You've got the interest expense. That one also we've calculated to give us a net profit for the year of 2,720,000. Okay, guys, that was now how you use your adjustments to complete your statement of comprehensive income. What is most important is to take every adjustment and show its effect on the statement of comprehensive income. In other words, show your calculations. And once you do that, obviously, you then complete the statement of comprehensive income. Once again, a recap. Which are the adjustments that you're looking for? Accrued income plus deferred income minus. What am I referring to? The operation in the bracket. Accrued expenses plus prepaid expenses minus operation in the bracket. Consumable stores on hand minus operation in the bracket. With consumable stores on hand, be careful. Are they giving you the amount that you've used or the amount that is left over? This particular example did not have anything on consumable stores on hand, but what you're going to do now is get your hands on as many income statements as you can, look at past papers, work through your questions, and as you'll notice that when you walk into an exam room, you have to walk into an exam room with BMT. BMT. What is BMT, guys? Big match temperament. By that we mean, if you practice adequately, your confidence is at a high, and definitely you will have BMT when you walk into an exam room. Ace that accounting exam, because Ashraf and the crew have worked very hard for you to ensure that you will always be an accounting shining star. Until next time, be good. Goodbye.